Afternoon, and thank you all for joining us today. My name is Corey Hoffer. I'm with Hermitage Wealth Management, and I'm excited to get started into our Q4 2024 market outlook. Joining me today is Garrett Melson, who's a certified financial analyst with Natixis Investment Managers. Garrett, welcome from Boston. I know a little bit about your background. You're a Boston College guy and got your MBA from Northwestern and spent some time with Fidelity as well as Wellington and now Natixis. And I know you're a portfolio manager and a member of the investment committee up there. And for those of you who may remember the name Natixis, it's because we used a lot of their research and their data during the COVID period. So I'll always be thankful for Natixis for providing some really good data, up-to-date, factual information about what was happening in the markets and how COVID was affecting us. It was a very uncertain time in which I think we had a lot of questions. And because of what Natixis did on the research side, we were able to bring a lot of that good information to our clients, which I think made them feel better. So thank you again for Garrett for being here. Thank you for that. And we're excited to hear what you have to say today. I know you're going to kind of give us sort of a three-part overview. Number one, a recap of where we've been over Q3 and now into Q4 this year. And then I'm hoping you're going to talk a little bit about where we're heading in terms of the economic backdrop over the next few quarters and what you're seeing together with the research that's being done at Natixis. And then I also asked you to talk today a little bit about the election, the results of the election, and what type of economic impacts that might have on the capital markets as we move forward. So, again, thanks for being here, and we'll look forward to hearing what you have to say.
Great. Well, thank you very much for the introduction there and really appreciate the time to spend with you today. That's a great overview in terms of the content I want to cover. I think there's quite the change in the market's narrative over the quarter leading up to the election. Obviously, a lot of turmoil, a lot of volatility in the market, which is kind of the norm and par for the course in the lead up to an election here. So I think it's helpful to kind of look back at where that narrative has evolved and where we are today. And then, as you mentioned, certainly look out into what the momentum right now underlying the economy is, and ultimately just close out with a couple thoughts in terms of how some of the agenda under the incoming Trump administration might shape that outlook as we look into 2025 here. So jumping right in, I want to start off with the first slide here. I think the way to summarize the third quarter is basically a pretty sharp shift in the narrative. And basically, that's just kind of what the market pricing is in terms of where we're headed from an economic perspective. A shift in the narrative from basically markets being very fearful of a looming recession and cracking within the labor markets to one where we're no longer worried about the recession, no longer worried about cracks in the labor market. And on the contrary, we're actually a little bit too worried about the strength in growth leading to stickier inflation above the Fed's 2% target here. So that's a narrative that we've kind of coined the no landing over the last couple of years. You feel a lot of these kind of landing conversations in the media, soft landing, Goldilocks, no landing, hard landing. But I think we've kind of come full circle from that hard landing or recession outcome to something that looks a little more like a no landing, or I'd say a strong growth and maybe a somewhat modest inflationary backdrop. I wouldn't get too carried away, though, with that narrative. And I think there's a couple of reasons why. We've seen that narrative oscillation quite extreme over the last 2 years. And so we've kind of gone from one extreme to the other. And that tends to be what markets like to do. Markets love to overreact and overshoot in both directions. But we've been basically playing ping pong with that narrative over the last couple of years. And I think we're kind of in that type of backdrop now where the market's gotten a little bit carried away. It's not quite as extreme of an overshoot, but I still think it's a little bit of an overshoot nonetheless. And I think that ties neatly into where we think things are headed over the next couple of quarters here. So jumping in, I like charts, and so I'm going to share a lot of charts here with you. If you don't like the charts, then you can ignore what's on the screen in front of you and just listen to kind of the commentary that goes along with it. But I do think it helps for those who are kind of visually inclined like myself to kind of put some context around some of the comments here. And the first one really does start with, I think, what the heart of the issue was with some of that hard landing narrative, which was the cooling in the labor market. And undoubtedly, we have seen a cooling in the labor market over the last couple of years. What you're looking at on this first slide is just simply the number of jobs added to the economy every single month. And this is the non-farm payrolls print. We'll get the latest print on this Friday. But you can see a pretty steady trend here that each month is represented in the blue bars, and then we put over a 3-month average. So you can kind of get a sense of where the trend is headed. And very clear, you can see from very robust levels of job gains, coming out of the pandemic era, and just steadily declining back towards that red line, which is basically the pre-pandemic average of job creation on a monthly basis. So we've actually breached down below that, which suggests that we've seen a pretty significant cooling in the labor market. Obviously, as markets like to extrapolate recent data prints and kind of overshoot with that narrative, you can see how that would start to kind of grow some concern and fear in the markets that we're going to get some pretty soft payrolls prints and maybe actually see some job losses at the national level. Now, I'll point out the most recent print. You can just barely see that bar. That is very distorted by the hurricanes that we had in the southeast of the country back in the month of October here. So there is some noise there, and we'll probably see some recovery from it at the coming print on Friday. But bottom line is the trend is pretty clear. You've seen cooling, but there have been some signs of maybe a little bit of a stabilization there, and I think that's where you start to see a shift in the narrative. If we jump ahead to the next slide, what you'll see is basically the lifeblood or the engine of the economy continues to do pretty well here. So while there have been areas of concern, namely around the labor market, when it comes to ultimately consumption, which drives about 70% of the economy, things are still looking just fine on that front here. We just simply deflated. So we're taking retail sales that come out on a monthly basis, and then we're adjusting that for inflation to give us a sense of what the real growth is in the economy, basically volume growth in the economy, not just prices. And you can see that we've overlaid that with the trend line for those retail sales. And we're specifically looking at core retail sales. That's really what matters and kind of flows into GDP and the growth measure that we look at for the economy. And you can see two things. First, we're at basically a level step higher above that trend. So we've shifted higher during the pandemic era, and then we've kind of stabilized along that trend. But if you look at the slope of the more recent, I'd say 12 to 18 months, if anything, it's actually a slightly higher pace or slope to that line than the pre-pandemic era. So what does that tell us? Well, one, we've seen overall consumption just kind of level steps higher, and now we're actually on somewhat of a stronger run rate moving forward here. So it actually suggests we're seeing a little bit stronger consumption than what we had in the pre-pandemic economy. So things are still humming along when it comes to the lifeblood of the economy. And so on the next slide, you'll see basically aggregating all the key inputs into GDP growth. And you'll see that, the red line here, that's just overall GDP growth. That's the number you'll hear in terms of how fast the economy is running on a quarterly basis. And we're running at pretty healthy levels right now, stabilizing right around 3% growth. You go back over the last, 10, 15 years, and we were averaging something closer to about 2.25 in terms of GDP growth. So again, more signs of kind of stabilizing at a somewhat higher level of growth here. And it's coming from a lot of components here. All those bars represent the key drivers. You're not getting a whole lot out of fixed investment out of companies right now, CapEx expenditures, not getting a whole lot out of the residential investment, which is the housing market. That's basically ground to a halt. But at the same time, that lifeblood of the economy, the light blue bar, consumer spending is doing just fine. And you're getting a little bit of a kicker as well from government expenditures as well. So overall, growth is healthy and holding pretty steady. Now, as we talk about the evolution of the narrative, if you jump ahead to the next slide, I think this really summarizes it all in one slide. What you're looking at is the City Economic Surprise Index. And this is an index that a lot of market participants keep a close eye on because at any one point, we're getting just an avalanche of economic data. And this is one way to basically summarize that data and then compare that to what expectations are. And it's important to compare that to expectations because that's going to be essentially what affects market pricing, right? It's not just how the data comes in, but it's how that data is coming in and evolving relative to how investors expect it to. And if you start to see some upside surprises to data, well, right now we're in a regime where good news is good news, and that ultimately helps to fuel asset prices higher here. So I think that's exactly what you can see in this chart, which is one, the economic surprise index in the light blue, which tends to mean revert. And what I mean by that is you tend to see that it oscillates over time. You basically have this dynamic where investors get pretty confident, data, they kind of catch up to strong data, and then ultimately they get a little overconfident and they overshoot, and now data starts to soften relative to those expectations, and now you start to see it roll over, and you can see the same dynamic play out in reverse. So basically, anytime this line is moving higher, that means data is coming in ahead of expectations. Anytime it's moving lower, data is underperforming expectations. And so you can see that kind of oscillation up and down around zero. Now, I think what's important is that the more recent uptick in that we saw basically from the beginning of September, and that's really when a lot of those recession fears hit a zenith. Well, you actually see that the purple line inflected higher as well. So why is that important? Well, as I mentioned, that line can move higher. The light blue line can move higher just from the sheer fact that expectations are kind of more muted. And the data is not great, but it's beating expectations. So the light blue line moves higher. This is actually a case of the data itself actually started to reverse course. We'd seen a pretty meaningful deterioration in the data basically from the beginning of the second quarter through the summer. But basically at the right around September, where you started to see that narrative shift, all of that data started to pick up, and you actually saw that inflection higher here. So it's an inflection in not only the data flow, but also relative to expectations. And that's what really helped to fuel that narrative change. Now, jumping ahead, why does that matter so much? I mentioned it's relative to expectations that matter here. And you saw a pretty sharp repricing in markets. Now, equity prices continue to kind of move higher and grind higher. But over the last 2 years, I'd say a lot more of the action has taken place in the bond market. And that tends to be, the boring part of the market that a lot of investors just don't pay attention to. It's just bonds, you get your income and you kind of move on. But that's actually been kind of the tail wagging the dog for risk assets over the last 2 years. What's going on in fixed income markets and rates and all the volatility there has really been driving volatility in other markets across the globe. And so on this slide, you can see kind of the rubber meeting the road. That light blue line from the prior chart, that economic surprise index, again, now you can see a much longer time or record here of that mean reverting nature where it goes up, kind of hits peak and then rolls back over. Well, what does that tend to track closely with? Tends to track closely with changes in the U.S. 10-year Treasury yield. So as data gets softer, that light blue line rolls over, then yields tend to roll over because you're pricing in a softer growth environment, maybe starting to price in, more accommodative policy from the Fed, and vice versa. So again, why does it matter so much that the data started to inflect higher over the last couple months? Well, that ultimately drove a pretty sharp repricing in the rates market, and you can see that in the purple line following suit, moving higher here. Now, it's important to think about what is actually driving rates. And on the next slide, you can kind of think about interest rates from two components. What you'll hear quoted is just that nominal 10-year Treasury yield, and that's the blue line here that you see here. And you can see how aggressive that move up was for the 10-year Treasury yield. We widened out at the peaks back at basically the week after the election, almost 85 basis points, so 0.85% higher than basically the low when we were pricing in all that recession fear. But it wasn't just because of growth or inflation. It's a little bit of both, and that's what you can kind of disentangle here and decompose. The green line is basically the market's expectation of inflation out over the next 10 years, and the purple line is basically the market's expectation of growth. So that's essentially what drives nominal yields is inflation expectations and growth expectations. What did you see here? Well, the first move off the lows in yields was kind of a combination of the two. You saw inflation expectations and growth expectations rising in tandem. And that is a reflection of walking back all that recessionary pricing in markets. But basically, since the middle of October, that broke down. You saw inflation expectations were stable, and it was all driven by higher growth expectations. And this is kind of where we started to see the market pricing in a pro-growth agenda from higher odds of a Trump win in the election here. But this matters because you saw basically the walking back of recession risks, then giving way to pricing in a stronger growth backdrop, but not necessarily one that was all that inflationary. So what does that mean in terms of kind of the rate expectations, the Fed policy expectations moving forward here? A couple things to consider, and all that kind of helped to drive that back up in yields, and why ultimately we've seen yields roll back over, as you can see, since basically the second week of November. So the first thing to think about, next slide, you'll see the market's expectations of Fed policy over the next couple of meetings here. And we just heard some comments from a couple members of the FOMC, Powell himself, just this afternoon speaking in New York. But what we've seen is the market shift pretty dramatically its pricing for policy rates going out to the middle of next year. And basically, these bars are just showing you what's the probability of a cut priced into the market. Sure, Corey.
So where do you envision that? So what this is telling us is that right now there's 70% odds that there will be a Fed cut in December, this month.
You got it. And that's coming from basically the end of September, pricing in some probability of maybe cutting not just 25 basis points, but maybe even 50 basis points because growth was so weak. But right now, we're sitting right at about 70% odds for that meeting coming up.
Okay. And then a 26% chance in January and 61 in March. I'm interested, Garrett, with your background in fixed income. What are your thoughts? Is that 70% inaccurate, or would you go higher or lower for a Fed cut later this month?
Yeah. So first off, I'd say these bars, the blue bars blowing up way past 100%, that always felt too much. And then again, as we kind of walked through, that was a reflection of that recessionary pricing, the fact that growth was going to be so weak, labor markets cracking, the Fed would have to ease aggressively. We were
Hmm.
never in that camp. And you go back to kind of the soft landing, hard landing, no landing. We've been very firmly in the soft landing camp for 2 years now.
Yeah.
And to that end, I'd say that 70% for the December meeting is actually a little bit low. And it's not so much that we think that growth is falling off, but we think that inflation is durably settling back to target. And that means that the Fed can recalibrate policy. They don't need to be restrictive anymore. They can get back to something that's more neutral in the sense that they're not really stimulating the economy, but they're also not trying to hold back growth. And so from our opinion, I'd say probably 100% odds of a cut at the December meeting. But then I'd actually follow along pretty closely with what the market pricing is going out over the next 6 months after that. You can see basically the market's pricing in an every other meeting cadence. So the Fed probably skips and doesn't move in January, then maybe cuts 25 basis points in March. Again, another pause and then another cut. That's kind of how I would expect things to play out, given our outlook on the data right now.
Very good. Thank you, Garrett.
So again, as I mentioned, this is a pretty sharp repricing in terms of the Fed's outlook. And if you go to the next slide, you can see the same idea, just a slightly different look. This is essentially looking at where the market is pricing Fed policy rate to be by June of next year. And you can see how much it's oscillated. And this basically lines up with how the market's narratives have shifted. So when you see this lower, that means that essentially the market's pricing in much more in the way of cuts from the Fed. And as it goes up, it's saying that the Fed's not going to be cutting all that much at all. And you can see how aggressively this has oscillated over the last year and a half. And going back again to September, we basically priced out 100 basis points of cuts. So 425 basis point cuts just over the last 2 months that have been priced out from a market's perspective. That probably gets us to a little bit more of a fair assessment of where the Fed is likely to move. But ultimately, it's going to come down to the data flow here. And we can certainly see how far we've moved off from what was probably a little bit too aggressive of a rate cutting cycle from the Fed. Now, the last couple components to kind of keep in mind, not quite as relevant for now, but on the next slide, you can see this was a part of what the narrative was leading into the election. And this was the fact that, again, we talked about all that volatility in the interest rate markets. This is a reflection of it. So, a lot of investors might be familiar with the VIX index or the volatility index. It's kind of a fear gauge for fear within equity markets. But there's a similar index that we track for fixed income markets, and it's called the MOVE index. Basically, we're trying to gauge what's the volatility that markets participants are pricing into fixed income markets, into rates markets. And we can actually look at it not just for the next 30 days, but kind of a term structure. So look at it the next 30 days, look out over the next 3 months, what's the difference in volatility there? And so when you see this line spike higher, it's saying that near-term volatility is very high relative to what the market thinks volatility will be 3 months out. And that tends to occur around crises. And I've actually highlighted a few here. Basically, the most extreme moves that we have on record, no pun intended, for the MOVE index, is COVID, the Ukraine invasion by Russia, the collapse of Silicon Valley Bank in early 2023, and then here, the 2024 election. So basically, the market just didn't really know how things were going to play out because there was just too tight of a race when it came to a lot of expectations. And as a result, there's a lot of volatility in the rates markets here. And so if we actually jump ahead to 2 slides, you've seen a lot of that volatility come down. But again, going back to basically what a lot of the fundamentals are saying versus where the market narrative is, you can see the disconnect. And this, I think, is a really helpful chart to kind of put into context how that narrative can evolve. What we've done here, and I know there's a lot going on, but basically we have a model puts a lot of the fundamental inputs into what drives 10-year treasury yields. And basically, as we mentioned, it boils down to growth expectations, inflation expectations, and then at the margin, you can have some other effects, right? It can be a reflection of what the Fed policy rate is that we just walked through. It can be a reflection of, some positioning of investors in the marketplace. And also, can have effects from global treasury bonds. So if you look abroad to, where bonds are trading in the Eurozone, where Japanese government bonds are trading, they can all have effects on where U.S. bonds trade as well. And if we put that all together, you get essentially this purple line, which is what a lot of the fundamental data and some of that positioning data suggests that the 10-year treasury yield should be trading at. You compare that to the light blue line, that's the actual yield on the 10-year treasury yield. So the gray bars are just tracking the difference between it. And what you'll notice is that when these gray bars get very elevated, that just tends to suggest that the market is maybe overshooting, maybe pricing in too high of yields. And when that happens, what do you tend to see? You tend to see very sharp reversals in yields coming crashing back down because the narrative just got a little too stretched, carried away, and ultimately yields recover. And that's exactly what we've seen play out 3 times over the last year or so. And that happened again in the wake of the election. So again, pricing in basically stronger growth, maybe inflation, maybe a higher inflationary environment under Trump's victory, and now starting to walk some of that back and getting back to a little bit closer of where that fair value is based off of a lot of the fundamentals in the market. Now, the last thing I wanted to just touch on is there's a little bit of volatility at the end of the third quarter. And if you look at the next slide, this kind of puts into context why fixed income has mattered so much for the equity markets. And it's that it's not so much what the level of yields is, but it's how fast those yield changes happen. And specifically, when you tend to see yields moving higher very quickly, it tends to drive some indigestion in risk appetite for the market, especially on the equity front here. So you're just looking at gray bars that are showing essentially the 2-month change in the 10-year treasury yield. So when those bars move up above this red line, that means it's been a very, very sharp increase in 10-year treasury yields. And when you compare that to the light blue line, which is just simply the S&P 500, you can see it tends to align pretty closely with areas of, maybe a slight pullback in the market or a little bit of chop. So you stop seeing that line grind higher and it kind of moves sideways for a little bit because markets are having to digest that move. That's exactly what we got as a result of all that repricing in the third quarter, a little bit of kind of indigestion at the end of October. But basically, since the election results, it's been just bulls back on the run here and equity markets pushing back to all-time highs. So a lot to walk through here. And I know we got kind of into the weeds in terms of the rates market, but I think it should be pretty clear that over the last couple of years, and especially over the last couple of months here, you can see just how important the market pricing of that narrative is to rates markets and then subsequently to what we see playing out in the equity markets here. So as we sit today, we've had a pretty sharp reversal, and I think markets are pretty confident that we're in a pretty strong growth backdrop, maybe a little bit too overconfident here. And that's what I think that you're starting to see play out in terms of rates rolling back over a little bit. But this is where I think our outlook differs a little bit. And that's why we want to jump into some of the things to consider on the outlook front from an economic perspective. Growth is still holding up just fine, but I think there's some reasons to expect things to slow down, at least at the margin, as we look out over the next couple quarters.
Yeah, and I can't help but notice your warning line there. Is that something we should be concerned about, or just a matter of time before yields kind of follow suit?
Yeah, so I mean, we breached through that warning back, I'd say, in October and through most of October, and we saw that chop around in the equity markets.
Hmm.
Right now, that rule doesn't really work in reverse. So when you start to see rates coming back down, that actually tends to be, at least if it's not too aggressive because markets are pricing in recession risk, that actually tends to be somewhat supportive for risk assets. And that's certainly what you've seen in the wake of the election here. So
Hmm.
while rates are, still a little bit more elevated than we've gotten used to over the last couple of decades, or last cycle, I should say, we certainly have come off the boil a little bit. That's something that we always kind of keep in the back of our mind anytime we start to see yields moving pretty aggressively to the upside. But
Yeah.
I think, if anything, as we're kind of walking through the next couple of slides, you can see some reasons why maybe yields are going to be a little bit more contained as we look through the next couple quarters here.
Great. And a great segue into this next slide. I see economic air pocket looming question mark. So tell us about that.
Absolutely. So we coined it kind of an economic air pocket. That might be a little dramatic. Ultimately, I think it's just some reasons to expect that the pace of growth might be a little bit more modest. So again, pushing back against that market narrative that we're kind of back into this strong growth, kind of stickier inflation backdrop. We're still sticking with the soft landing, pretty healthy growth, and ultimately a backdrop where inflation can continue to cool back off to target. So on the first slide, we talked at the top of this about basically what prompted a lot of the fears in the markets, and that was the labor market, and that tends to be the foundation of a lot of the work that we do. We focus on the labor market because ultimately it's jobs and incomes that are going to be driving consumption, 70% of the economy here. What we saw over the last couple weeks, last couple months, is a little bit of a deterioration in initial jobless claims. That tends to be our highest frequency data point that we have to track what's going on within the labor market. We get monthly jobless job numbers, but every single week we'll get a look at what jobless claims are showing us. And the red line you can see is basically that deviation away from what we typically see at that week of the year. So we're not adjusting this for seasonality. We're just showing it, and you can see what the typical seasonal patterns are. And the red line moving higher suggests more jobless claims, which suggests maybe a little bit of a softer labor market. And what you'll see is we actually excluded the hurricane affected states just because of the distortions from that. Well, we've gotten right back to basically the traditional seasonal trend. So a little bit of weakness, that's actually kind of evaporated over the last couple of weeks. And we're back to a pretty stable backdrop from a jobless claims perspective. Now, that's not to say we're completely out of the woods, because we have continued to see softening in the labor markets. But again, maybe not so much the fear on this front. So there's other reasons to suggest that maybe growth is going to be a little bit softer. On the next slide, two big drivers, I should say, of the strong growth that we've experienced over the last year and a half has been housing and inventory investment. Inventory investment is basically companies investing in new products. They're basically building those products to be sold. And it's not when the products get sold, but it's rather when they get produced that actually drives a contribution to growth within the economy. We basically put those two factors together, and what you're looking at on this light blue line is the contribution that they're providing to GDP growth. And you can see we were moving from an area where they were detracting quite a bit of growth from the economy to one where they're actually contributing a little bit. But it's not just that they're contributing 1%, but it's moving from -2 to +1. That's a 3% impulse to growth in the economy. So that's a very big driver. It's basically a segment of the economy that was basically down and dead when housing was really slowing down in 2022, came back to life in 2023. Now it's kind of slowed back down again as a result of exactly what we just walked through. Interest rates pushing higher and mortgage rates adjusting higher again on the back of that. So we've seen contributions that have been helpful to growth from housing and from inventory investment, but those tailwinds are probably going to be fading a little bit as we look over the next couple of quarters here. And a couple of reasons why. On the next slide, specifically inventories, what you tend to see is this tracks what companies are saying about their inventory levels. So if we take just that last slide and look exclusively at the inventories portion, that's what you're seeing here on the purple line. That's the contribution to GDP growth coming from inventory investment. And we've overlaid that with a manufacturing survey that goes out and asks manufacturers, what are you seeing for your customers' inventory levels? Are they too high or are they too low? And we've kind of flipped that around. So when that light blue line moves higher on this chart, that suggests that customers are saying their inventories are too low. What does that mean? That means we need to produce. And so no surprise here that you see the purple line move higher. That suggests that contribution to growth coming from production in the economy and vice versa. Where do we see inventories now? Well, maybe they're a little bit light, but by no means are they extremely light. And if anything, it suggests that we've probably done a little bit too much in terms of rebuilding inventories over the last couple quarters. So don't expect a whole lot out of the way of production coming in the next quarter or two. And that will be a mechanical drag on growth. Now, going back to the housing market, what do we see playing out there? On the next slide, you can see the effects of higher interest rates on mortgage rates. So there's a very tight relationship over the last couple of years between mortgage rates and purchase applications. We can actually track the number of applications for mortgages to buy a new home, not excluding refinancing activity, just exclusively for buying a new home. And we've seen a very tight relationship. It's broken down a little bit more recently here. So as mortgage rates have rolled over and softened up, through the summer months, you actually didn't see a whole lot of activity picking up in terms of mortgage applications. And then you actually saw the exact opposite. You saw rates back up and mortgage applications dropped as a result. You've gotten a little bit of a better pickup here more recently as rates have softened back up. But again, that's very small. If I was to kind of expand this out and you look at the scale of it, you can hardly see that. It looks like a blip on the radar here. So yes, at the margin, housing is picking up a little bit, but I think there's reason to expect it to be somewhat soft as we look out through the next quarter. Because if you think about it, it's not just home buying activity, but it's the construction activity. It's a lot of other components that go into housing contributions to growth. And on the next slide, you'll see that essentially because we've had a lot of construction over the last couple of years, but now purchase activity has slowed down. On the next slide, you'll see that essentially the number of houses that are currently being built has plummeted. So essentially, you can think about housing as a flow of homes that are now breaking ground, so new construction, versus homes that have been completed and are available for sale in completed state. And what you see over time is that the number of units under construction, which is essentially the sum of that process. So if starts are happening at a faster pace than the completions, that means the number of homes that are under construction is rising, and vice versa. And that's exactly what we're seeing now, is that the number of homes under construction is falling. And that suggests that contribution to growth in the economy is probably going to start fading over the next couple of quarters here. Again, it's not a death knell to housing, not a death knell to the economy, but it's more of a near-term hiccup that leads to slightly softer growth coming from housing in the economy. Yes, Corey.
Yeah, what is this telling us though? I mean, is it a function of rates that are, keeping housing
Yeah,
starts down so low?
exactly.
I mean, there's certainly no demand for housing in the US, and we know that in almost any market. However, housing starts being as low as they were in 2008 is somewhat concerning to me because, as you said, it's got so many different tentacles out into the overall general economy. So why are housing starts so low?
Yeah, so it has a lot to do with the path of basically the last couple of years here. You saw a massive explosion in starts and construction basically through the pandemic era.
Yeah.
And what you've actually seen is that they had a very large pipeline of homes under construction, and they finally started to work through that. And so now, with interest rates still being somewhat high, you see a lot of surveys out there of what it's going to take in terms of mortgage rates, prevailing mortgage rates, to really drive a lot of buyers back into the market. It's somewhere probably under 6%. And right now you're looking at mortgage rates closer to 7%.
Yeah.
You need to get durably under 6%, maybe closer to 5.5%, to really start to see that demand pick back up. And so I think what you've seen is a lot of home builders have gotten through that pipeline of units under construction. They're slowing down starts for now. As rates start to calm down and cool back down, you'll probably start to see a lot of activity pick up, because there is structurally a lot of demand domestically and a lot of undersupply. We just simply don't have enough homes. But it does really boil down to a function of rates. And right now, the math just doesn't work, even with some of the buy downs, rate buy downs, and other concessions that home builders can make to make it a little bit more attractive. So again, a reason why we're in a little bit of an air pocket where you just shouldn't expect a lot of contribution from housing, which generally drives about 20% of growth in the economy.
Right.
So
Yeah.
again,
Interesting to see.
not a death knell, but a near-term headwind.
Yeah. Interesting to see how it'll play out and how Jay Powell and the Fed kind of react to some of this data.
Yeah, absolutely.
Yeah.
So, the last couple slides here I want to touch on, on the next one, we mentioned government spending being a big driver. Another one has been, industrials, and namely Boeing. Now, government spending, you're probably going to see a little bit of that slow down, because a big driver was defense spending in the third quarter. I wouldn't expect to see a whole or a repeat of that in the fourth quarter. So again, another kind of mechanical drag on growth, just because it's going to be a little bit softer. Again, not falling off a cliff, but just mechanically, things at the margin are a little bit cooler in the fourth quarter, maybe into the beginning of next year. And Boeing, as a result of the strikes and other issues that they're dealing with, you can see just how big of a driver they've been to basically transportation equipment shipments here. So I've broken it out between aircraft versus transportation X aircraft. And the big takeaway here is that a lot of that spending over the recent quarters in the blue bars has been coming from basically non-defense aircraft. That's Boeing. So you should expect to see a little bit of a softer print. Yes, we've resolved those strikes, so that should get back online. You'll have a catch-up effect. But again, because of some of the issues that they're dealing with, you might see some of that catch-up delayed into something like the second and third quarters of next year. So again, another kind of mechanical drag on growth. Now, why, after walking through all these kind of headwinds to growth, are we still pretty optimistic? And it boils back down to the election and the consumer. So on the next slide, you'll see some of the volatility in basically uncertainty in consumer and business sentiment within the economy leading into the elections. And this matters because what you heard a lot through a lot of surveys from the Fed, from some of the PMI data, even just from corporate management teams on earnings calls, is that the uncertainty around the election outcome basically had a lot of companies and to some degree, even consumers hitting the pause button. So a lot of decisions that had to be made for 2025 planning purposes were basically put on hold until we had a better sense of what the election results were and ultimately what the agenda would be for 2025 and beyond. And so what you're looking at this slide is the NFIB, which basically tracks small businesses in the economy. They have a policy uncertainty index, and we hit all-time highs on that as of the October data print. I would expect to see this roll over pretty dramatically. Now, this does tend to be a very partisan index and very partisan skewed towards the Republican side of the aisle. So you'll probably see a pickup in confidence here, which is just a sheer reflection of the fact that Republicans now have control of government. But the bottom line is the most important takeaway is that uncertainty is now lower. And what does that mean? That's good for businesses making investment decisions, good for businesses making employment decisions, and ultimately gives consumers a little bit more confidence. And so when you look at the effects of this, well, we've seen a little bit of slowing in some of the government data for payrolls, but on the next slide, something that we like to track is actually taxes that are deposited at the Treasury for income taxes. So when your employers withholding income taxes, federal income taxes, you can actually track that for the aggregate economy on a daily basis in the U.S. Treasury's basically bank account. And that's what you're looking at on this slide. We take a look at growth over this, and you can see the cooling we've had, but we're actually kind of stabilizing at pretty healthy levels. So while there has been cooling in the labor market, things are still holding up just fine, at least from an income tax deposits perspective. And that suggests that overall incomes are still growing pretty well. On the next slide, you'll see why that matters so much is that we're basically an income-driven economy. Consumers are spending, especially the U.S. consumer, the old adage goes, never bet against the U.S. consumer. And you can see, basically this is an aggregate of all spending or earning power, I should say, within the U.S. economy. And the way we kind of aggregate this is take that monthly jobs print that we'll get on Friday, take the number of people that have a job, multiply that by the average hours they work per week, multiply that by the average hourly earnings that they're making, and you can look at that growth rate over time. We're doing this not on a year-over-year basis, but a 3-month annualized basis. So it gives you a little bit better of a sense of what's happening near term. And things are holding up just fine. We're growing at about 5%. Again, a little bit of a distortion here from some of the hurricane noise at the most recent print, but that's basically at or slightly above the pre-pandemic average. So we talk about consumption still being pretty supported by consumer paychecks. Things are still doing just fine. People have jobs, they have incomes, and they're continuing to spend here. And if you jump ahead to the 2 slides, you'll see essentially that incomes are growing in line with consumption here. And so a couple different ways to gauge income growth. Consumer spending is in purple. And then disposable personal income. So this is after-tax income for consumers in light blue, and then just specifically wage and salary disbursements. So if we exclude like transfer payments, unemployment benefits, those sort of things, and just look exclusively at salaries and wages, well, they're all pretty much growing in line with consumer spending. So as long as consumers have a job, we talk a whole lot about savings and pandemic savings, but as long as consumers have a job, they'll continue to spend, and things look fairly well supported from here at pretty healthy levels. So again, not reason to, go panic and hit the pause button, go to cash, but just wanted to say that, growth has been pretty robust. Maybe the narrative's gotten a little bit extreme. We'll see a little bit softer growth, but still something that's probably about 2.5%, maybe a slightly slower for the next quarter or two. But things are still looking pretty solid for growth within the economy here.
Very good. Well, let's talk a little bit about inflation before we go over to the election and results. So if we go ahead 2 slides, I think um,
Yep,
here we are, nowhere to be seen.
absolutely. So I won't dig into all the different metrics here, but I think what's been helpful over the last couple of years, just kind of take a step back and look at first principles. Think about it from a big picture perspective. What drives inflation? And if you do that, you can basically boil inflation down to a function of it equals compensation, what businesses are spending for wages, less productivity growth, because that's a buffer to compensation growth. If you can get more output from each employee, and all that expenditure on employees, well, that means that you're getting, higher return for that. And ultimately that keeps prices in check because you're getting greater output in terms of volume of goods. And if you put those two together, you can see basically a proxy for PCE, which is the measure that the Fed really focuses on. So that's the light blue line here. And the wages that we were looking at is the Fed's preferred measure of ECI, Employment Cost Index. So again, we're just do compensation, ECI, less productivity. That's the purple line here. You're tracking just inside or basically right around 2%. Now, it is taking a little bit longer for inflation to get back down to target. And part of that is a function of how inflation is measured, namely the shelter component, which is a big portion of the inflation basket and one that is intentionally lagged and has a lot of disinflation to come. So we know essentially that there's going to be a lot of slowing in shelter inflation. It just takes time to filter in. But when you look more broadly, you're just not really seeing evidence of inflationary pressures in the economy. And that's what that purple line is telling you. So things are cooling down. It's taking some time. But right now, when you look at kind of the fundamentals, it's basically consistent with an economy that has inflation about 2%.
Very good. Very good. Well, let's talk a little bit about the new administration and how that could affect things like tariffs.
Absolutely. So I want to keep this somewhat short. First, because we've been covering a lot of content, but second, because to be honest, we just simply don't know a whole lot about what the agenda will look like and what the actual proposals will be. So this ties directly back to Fed policy. We've heard quite a bit about, well, if we do see tariffs, is that going to be inflationary? If we see stronger growth from a pro-growth agenda from Trump, is that going to kind of hold back the pace of inflation falling back to 2% and ultimately meaning that the Fed has to be a little bit more hawkish and not ease as much? At the end of the day, the Fed doesn't know, neither do we. And so a lot of this is basically estimates on what might happen. Right now, as we just kind of walk through, the outlook, I think, is still pretty good. Growth is pretty solid, and that's, I think, what matters bigger picture for the economy as we roll into 2025. But when you think about tariffs, there's a couple things I just wanted to focus on in terms of their potential effects on growth, because I think this is the biggest kind of area of uncertainty and also one of the biggest misconceptions within economics and markets. Now, there's two reasons that you could really put on tariffs. One is that you can outright just try to protect your domestic industry. So if you have another country, China certainly being in the crosshairs for taking jobs away from industries that you want to have domestically producing, well, you can put on tariffs to protect that. But if you do that, you need to make sure that you're putting those tariffs on high enough so that it forces consumers and businesses to basically buy the domestic alternative. What does that mean? It means you're not going to get a whole lot out of revenues from tariffs because consumers are going to shift their spending patterns back to the domestic alternative, which doesn't have a tariff, right? Now, if your objective is to raise revenues, which is what Trump has also talked about, then the key is that you can't raise those tariffs too high to drive that substitution effect back to something, that isn't subject to tariffs. And so as a result, you have this kind of balance between these two objectives. Which one is Trump more serious about? Is he really serious about basically replacing revenue for the government from tariff revenues? Or is he more focused on, right sizing the trade deficit, bringing back manufacturing jobs domestically which one is it? Because those are going to have pretty important implications in terms of the size of potential tariffs. The other one is who actually pays for these tariffs, because that matters for some of the ripple effects into the economy. And on the next slide, there's basically four different ways you can think about this. By law, the way that tariffs are handled, they're not paid by the foreign country or the foreign company. They're actually paid by the importing agency or importing company here in the U.S. So it's a U.S. company and a U.S. distributor that actually pays and writes that check to the Customs and Border Protection Agency. So it is actually paid here. Now, ultimately, how businesses along that chain make decisions can affect who is actually paying for that ultimately. Now, the first option is that a foreign seller can actually lower their price. So if you raise tariffs 25%, well, that foreign seller can reduce their price 25%, so there's no net effect to the U.S. consumer. Are companies going to do that necessarily? Because that's a hit directly to their margins. Hard to say, especially when China right now is really driving their growth on their export engine. So hard to say that whether they do that or not, but in effect, that might actually reduce the burden on the consumer. Now, the next option is that foreign seller doesn't lower their price, and ultimately consumers shift to a domestic alternative. Well, now the foreign seller doesn't get revenues, and you're not paying a tariff to the government because you're shifting to a domestic company. That might be actually a good thing because you're seeing domestic revenues stay domestic. And ultimately that can get funneled back into the economy and into jobs. Now, the other alternative is that domestic buyer just simply passes on that cost to the consumer. So as I mentioned, when the importer pays that tariff, well, they don't want to take the margin hit, so they're just going to raise that price 25%, and now you and I are shouldering that burden. So what does that lead to? Well, it can lead to demand destruction, essentially. If we're having to pay 25% more for the same item and our wages aren't going up, that means that we're going to have to probably cut back on other areas of the spending. So that's why you'll hear a lot of times that tariffs can be considered something of a tax on the consumer, because you can't rely on the fact that the manufacturer is going to cut prices and the importer is going to not pass along those price increases to consumers here. Now, the last one is essentially is where you start to see that the producer in the domestic market has essentially paid the tariff, and that's when the foreign seller doesn't lower the price, but the domestic importer essentially absorbs that margin hit that I mentioned. That's probably the most unlikely of outcomes here, because companies are for-profit businesses, and U.S. companies are probably not going to want to take that margin hit here. So again, there's a lot of different ways this can all play out. What is the motivation for Trump behind the tariffs? How big are they going to be? How broad are they going to be? What countries are they going to be? What products are they going to be on? And ultimately, that has important implications for who shoulders that burden. But at the end of the day, there's a good chance that some of that gets burdened, some of that burden is shouldered by the U.S. consumer, and that ultimately translates to lower growth here in the U.S. And that can have something of a negative feedback loop, because if you start to see consumption pared back in some areas of the economy, well, that means that there's less revenues, that means that less employment, and that can kind of be a snowball effect here. So there are some serious risks to think about. Now, at the end of the day, Trump has shown us that, the biggest kind of benchmark for his policies is essentially the stock market. And I think that's kind of how the market is operating right now. There's a kind of common adage from his first term of take Trump seriously, but not literally. And I think that's what, we kind of have to operate right now, given the uncertainty on this front. But that's something that markets are certainly going to have to contend with as we move into next year. How aggressive is Trump likely to be? And the shape of those tariffs is going to have pretty important implications on the economic outlook. Right now, we're in a pretty healthy spot. Maybe things are slowing down at the margin, but ultimately holding up just fine. But these are questions that we'll have to wrangle with as we move into next year.
Very good. And Garrett, I was hoping you could also talk a little bit about how different sectors in the market could be affected by policy. Now, of course, we don't know what those policies look and feel like right now, but I imagine they're based on what we know today, we can make some conclusions about how that could look and feel going forward.
Yeah, absolutely. So, there's a couple different considerations. One is, there certainly has been chatter about extending the Tax Cuts and Jobs Act tax cuts. So, those corporate tax rates are going to stay in place from what that policy was from 2017. But there's been some chatter of maybe lowering them even further. And so that has important implications when you think about who could benefit from that the most. Essentially, you see, some of those tech firms, consumer discretionary firms, and those are the names on the right side here at the bottom of the list, basically have the biggest benefit or boost to earnings as a result of that reduction in tax. Just think strictly about the broad policy agenda. This I think is sums up what we've seen playing out in markets, which is that one, you're seeing a more supportive backdrop for a lot of M&A activity, a lot less regulation. That helps in terms of tech firms. Certainly helps on the financials front, and ultimately a lot of agenda items that are focusing on supporting a stronger rate of growth here in the U.S. economy. So when you think about who benefits from that the most, you'll see a lot. We kind of built out this slide that you see in front of you based off of different outcomes for the election under Harris or Trump. But I think the easiest way to think about Trump administration is stronger growth or strong growth, and ultimately, not necessarily an inflationary backdrop, just because of some of the dynamics already at play in the economy. So that means you probably continue to see a lot of cyclical areas of the market perform pretty well. Banks have been on a very strong tear. I think that's probably an area that continues to do fairly well. Industrials, materials firms, all those kind of inputs to production benefit from stronger growth. Those are probably going to continue to be supported by that. And then on the flip side, technology, less of a focus on technology firms. M&A activity maybe easing up a little bit at the margin. That is all helpful for, I think, what we've kind of been playing in our portfolios, which is this tech and cyclical barbell. So you can get a little bit more into the weeds and a little bit more into the nitty gritty on specific industries, but that's kind of high level how we think about things. The one thing I would also point out is energy. Quite a bit of a focus on energy under a Trump administration. Keep in mind, what was the poorest performing sector in Trump's first term? It was actually energy. So as much as you hear a lot of talk about Trump being pretty supportive for the energy complex, he has pretty small impact on how they actually perform, just simply because you've seen a very stark shift in terms of how these companies are managing. Just because Trump wants them to drill more doesn't mean they will, because that ultimately leads to higher supply and lower oil prices, and ultimately it leads to lower stock prices as well. So, a lot to kind of unpack, but I think the easiest way to think about it is, strong pro-cyclical impulse in the economy, and that leads to probably pretty supportive backdrop for a lot of the cyclical areas of the stock market as well.
Very good. Well, thank you so much, Garrett. This information has been really helpful. You provided us with kind of a recap on how we got here, where we are, maybe where we're headed, going forward. And then I noticed one other slide in your deck that kind of looked at, maybe just getting past the elections is bullish. And I thought that was interesting. Maybe just the relief in the markets that we're kind of moving forward takes us into a little uptick in stock prices. But thanks very much for
Absolutely.
being here. I appreciate it, and we'll definitely have you back one day.
Well, thank you so much for the time. Really appreciate it.
All right. Thanks. And thank everyone else today who took part in the presentation. If you have any questions about today's presentation, please don't hesitate to call us here at Hermitage Wealth. Otherwise, it's been a pleasure, and we'll be in touch.